Welcome to Talk Tickers. We're your deep dive into the latest earnings calls.
That's right.
And today, we're unpacking M&T Bank's second quarter 2025 performance.
Yeah, a big regional player.
Our mission, as always, is to cut through the noise for you, pull out the crucial insights, the strategic shifts, and what it all really means.
And this quarter, M&T Bank's story is, well, it's really about de-risking and shareholder value, navigating a pretty complex economy.
Exactly. Precision seems to be the word. So let's start with that results snapshot. What did the operating numbers look like?
Okay, so operationally, they actually looked pretty strong. Their diluted net operating EPS that jumped to $4.28.
Okay.
Which is a nice increase from $3.38 last quarter. And net operating income, that came in higher too, $724 million compared to $594 million. So solid operational beat.
Right, $724 million operating. But I did notice the GAAP numbers looked, well, different. GAAP net income was actually down quite a bit sequentially. What's going on there?
Yeah, that's a really good point to bring up. That divergence, it's all down to a few specific notable items they called out. These hit the GAAP figures, but aren't really part of the core ongoing business performance.
Oh, okay.
So yeah, the diluted GAAP EPS was $4.24, which, is still up from $3.32 last quarter. But the GAAP net income figure itself was $116 million versus $584 million before. Big difference.
So what were these notable items specifically? What drove that gap?
Well, there were a few things pulling in different directions. On the negative side, they had a $17 million premium amortization. This was on some tax-exempt bonds tied back to the People's United deal.
Right, an accounting thing.
Exactly. And that reduced EPS by about 9 cents. But then offsetting that, they had a $15 million gain. They sold off a CRA loan portfolio that wasn't really in their main footprint.
Okay.
And that added 7 cents to GAAP EPS, plus another $10 million gain from selling an ICF subsidiary, which added another 4 cents.
I see. So net, those items explain the noise. Once you strip them out, the underlying operating picture looks much healthier.
Precisely. It clarifies things quite a bit.
Good context. Okay, so beyond just the EPS numbers, what other operational highlights really stood out for M&T this quarter?
Well, their capital management was definitely a big one. They returned, get this, $1.1 billion to shareholders just through share buybacks in Q2.
Wow, $1.1 billion. That's aggressive.
It is. But what's really compelling, even with those huge buybacks, their tangible book value per share still grew by 1%.
That is impressive. Usually big buybacks can eat into that metric.
Right. It signals real confidence from management in their earnings power and, their asset quality. They're creating value even while returning a lot of cash.
Okay, strong capital return. What else? I think I saw fee income was looking good too.
It was, yeah. Robust fee income growth. If you exclude those notable items we talked about, it was up 11% compared to Q2 last year.
Nice.
And expenses were kept well in check. Their efficiency ratio came in at 55.2%.
55.2%. And for folks maybe less familiar, lower is better there, right? Means they're spending less to make each dollar of revenue.
Mm-hmm. Exactly. And 55.2% is a pretty strong number, shows good cost control.
That discipline definitely helps the bottom line. And what about asset quality? Any movement there?
Yeah, significant improvement, actually. They reduced their commercial credit criticized balances by $1 billion. That's an 11% drop.
Okay, and criticized balances are basically loans showing some potential weakness.
That's right. Loans with a higher risk profile. So bringing that number down by $1 billion is a really positive sign for their risk management.
Definitely. And speaking of risk, their stress test results came out well too, didn't they?
They did. That's another key point. Their stress capital buffer, the SCB, it declined, went from 3.8% down to 2.7%.
And what does that signal, practically speaking?
It's a really strong indicator of their earnings power and just solid risk management. It basically means that even in a, really severe economic downturn scenario, they'd still have a very healthy capital cushion.
So more resilience.
Much more resilience.
Yeah.
Puts them in a good position relative to peers, signals stability.
Okay, that's a great snapshot to start. Really sets the stage. Let's really dig in now. Pivotal financial trends. How about net interest income, NII, and the net interest margin, NIM?
Right. So taxable equivalent NII, that actually ticked up 1% to $1.72 billion. So income was up slightly.
Okay.
But the net interest margin itself, the NIM, it dipped a little, declined 4 basis points compared to last quarter, landing at 3.62%.
Okay. So income up, but margin down slightly.
Yeah.
What was driving that NIM decline mainly? Any offsets?
Yeah, the main culprits were, well, that premium amortization we mentioned earlier kept having a negative impact.
Right.
Plus, higher costs on their interest-bearing deposits, that's a pressure point everywhere right now. And also a bit less contribution from what they call net free funds.
So pressure from funding costs and some accounting items.
Pretty much. But there were some positive offsets. They got a 7 basis point benefit from fixed asset repricing. And that included less drag, less negative carry on their interest rate swaps. In fact, if you actually strip out that premium amortization impact, their NIM would have been basically flat at 3.66%.
Ah, okay. So the underlying core margin was holding up better than the headline number suggests. That's helpful context. So looking forward then, what's the guidance for NII and NIM for the full year?
Management's guiding for taxable equivalent NII for the full year to be somewhere in the $7 billion to $7.15 billion range.
Okay.
And they see NIM averaging in the mid to high 360s. Now, that NII range is actually a little bit lower than they previously guided.
Oh, why did that?
Mostly due to the softness they're seeing in commercial and CRA loan growth. But they did say NIM could potentially hit 3.70% if loan growth picks back up, especially in those specialty CNI and CRA areas.
Gotcha. Okay, let's pivot to those loan dynamics then. What did the overall portfolio growth look like in Q2?
So average loans and leases, they grew by $6 billion. That brings the total up to $135.4 billion.
And what drove that $6 billion increase?
It was mainly residential mortgages and consumer loans. Those two combined were up about $1.5 billion, or 3% sequentially. That growth helped offset a decline they saw in CRA balances.
Okay. And commercial loans, they're obviously pretty key for M&T. How did they do?
On average, commercial loans were pretty much unchanged, around $61 billion. However, and this is interesting, they saw strong growth right at the end of the period. End of period balances were up $1.1 billion.
Oh, okay. So maybe some momentum building there towards the end of the quarter.
Seems like it, especially strength in their specialty segments like CNI, mortgage warehouse lending, and fund banking shows some resilience even if the average was flat.
Right. So pockets of strength, even if overall commercial was flat on average.
Mm-hmm.
Now, you mentioned that decline in CRA loans. How are they tackling that? What's the outlook there?
Yeah, CRA loans were down 4% to $25.3 billion. Management said that was mostly due to payoffs.
Okay.
But they emphasized the pipeline is building. Apparently, June was their best month this year for building that CRA pipeline. They have over $5 billion in it now.
So potential for growth later in the year.
Management thinks so, yeah. Especially if those specialty commercial businesses keep performing. They also mentioned they rolled out some new credit and sales processes earlier this year to try and, streamline things and capture more growth going forward.
Smart move.
Yeah.
Okay, flipping over to the other side of the balance sheet. Deposits. What were the key trends there?
Deposits looked pretty solid. Average total deposits rose $2.2 billion. It's about 1%, hitting $163.4 billion.
And was that growth broad-based?
Yeah, pretty much across the board. Commercial, business banking, consumer, mortgage, corporate trust, all saw some growth.
Okay. What about non-interest-bearing deposits? Still seeing pressure there?
A little bit, yeah. Average non-interest bearing saw a slight decline, about $0.3 billion. And the cost of their interest-bearing deposits ticked up just slightly, 1 basis point, to 2.38%.
And strategically, how are they thinking about deposits in this environment? Where's the focus?
Their big emphasis is on attracting what they call operating accounts.
Right, the core relationship deposits.
Exactly, the sticky money from businesses and individuals who are using the bank day to day, not just chasing the highest rate. They are bringing in new deposits at, competitive rates, marginal cost around 3.9% to 4.4%. But they're using that growth primarily to pay down more expensive non-core funding sources.
So a disciplined approach to funding, replacing higher cost wholesale with core deposits.
That's the strategy. Very deliberate.
Good sign. Okay. Let's shift to non-interest income. Sounds like that was a real bright spot this quarter.
It really was. A standout, you could say. Non-interest income jumped significantly to $683 million. That's up from $611 million last quarter.
Wow, that's a big sequential jump. What drove that?
A few things. Mortgage banking revenues were strong, up $12 million to $130 million. They mentioned that was helped by their new sub-servicing business that started back in February.
Okay.
And trust income also saw a nice boost, up $5 million to $182 million. That was partly seasonal, tax prep fees, but also reflects some investment they made in their European operations.
Interesting. Any other notable fee income drivers?
Yeah, well, you had those gains from the asset sales we already discussed,
Right.
but also higher loan syndication fees and growth in merchant and credit card revenues. But here's something I found particularly interesting. Treasury management revenues are up 13% compared to last year.
12 to 13% year over year. That's really strong for treasury management.
It is. It really points to deep client relationships, businesses relying on M&T for their core cash management and operations. That's sticky revenue.
Definitely a sign of franchise strength. And sticking with the income statement, how did they do on the expense side? You mentioned the good efficiency ratio earlier.
They did well there too. Non-interest expenses actually decreased by $79 million, coming in at $1.34 billion.
Okay, and what drove that decrease?
A big chunk of it, $74 million, was lower salaries and benefits. Management said that was mostly seasonal declines, although it was partially offset by their annual merit increases kicking in.
Gotcha.
And yeah, that helped drive that efficiency ratio improvement down sharply from 60.5% last quarter to 55.2% this quarter.
So really tight cost control, enabling that positive operating leverage.
Exactly. Management seems really committed to managing expenses closely so they can still make targeted investments where they need to. Controlling costs that tightly for a bank this size, it's not easy. Speaks volumes about their discipline.
Absolutely. And that discipline ties nicely into asset quality and capital strength. How did their credit performance look overall?
Pretty solid. Net charge-offs for the quarter were $108 million, or 32 basis points. That's actually down a tick from 34 basis points last quarter, and it's running below what they expect for the full year.
Okay, so charge-offs trending well. What about non-accrual loans? Any movement there?
Non-accruals, those are loans where payments are significantly past due. They did tick up slightly to $1.6 billion. That's about 1.16% of total loans. Management said that was primarily driven by some non-accruals in their C&I portfolio, specifically recreational finance dealers.
Okay, but didn't you mention earlier a big drop in criticized loans? How did they manage that?
Yes, exactly. Despite the small rise in non-accruals, the overall criticized loan book saw that huge $1 billion decline, bringing it down to $8.4 billion.
And where did that improvement come from?
It was driven by an $813 million drop in criticized CRA loans and another $226 million drop in commercial criticized. Within CRA, the improvement was mainly in multifamily, office, healthcare, and construction loans.
Wow. So actively working down problem areas.
Very actively. Management framed it as part of a multi-year effort. They're aiming to get criticized loans down to maybe half of their peak levels within a couple of years. Clear de-risking strategy in action.
That's a serious commitment. Now, what about the provision for credit losses? Was that number straightforward?
The provision was $125 million for the quarter, but that included a specific $20 million provision tied to unfunded credit commitments. It related to some credit recourse obligations for certain CRA loans sold under a specific Fannie Mae program.
Okay, sounds a bit complex. Was that a sign of broader issues?
Management went out of their way to say no. They described these as unique, kind of one-off situations involving very specific clients, like a manufactured housing project, a university multifamily deal, a senior living facility, and one renovation project that just had, bad luck.
So isolated incidents, not a trend.
That was the message. Very clear these weren't systemic. They expect the reserves for this specific business line to normalize, and they reaffirm that the underlying business itself is strategically important for fee income.
Okay, that context is crucial. Isolated issues handled. So shifting to overall capital then, how's the main capital ratio looking? The CET1.
Their estimated CET1 ratio ended the quarter at 10.98%. That's down a bit from 11.5% in Q1.
And that reflects the big share buyback.
Exactly, driven mainly by that $1.1 billion in repurchases, though partially offset by the capital they generated during the quarter. It's also worth noting the AOCI impact, those unrealized marks on securities, if that were included, it would actually add another 10 basis points to the ratio.
Right. And what's their target for CET1 going forward? Are they comfortable here?
For the rest of this year, they plan to operate in a range of 10.75% to 11%.
Okay.
They mentioned being a bit cautious given all the market uncertainty, tariffs, geopolitics, deficits, high asset prices, but their longer-term target is actually 10%.
So they feel they can run leaner eventually, but are being prudent now.
That seems to be the thinking. Keep a little extra buffer while things are uncertain.
Makes sense. And how do they think about allocating that capital? What are the priorities?
They laid out a clear hierarchy. Priority 1 is organic customer growth in their markets.
Oh,
Priority 2 is supporting a strong, growing, and importantly, repeatable dividend. They actually signaled board action on the dividend is expected this quarter.
potential dividend hike coming.
Seems likely. And then priority 3 is opportunistic share repurchases. And as we saw, they've been very active there, buying back 5.7% of their outstanding shares just in the first half of the year.
Wow, 5.7%. That's significant capital return. Okay, this gives us a really thorough look at the financials and capital. Let's zoom out a bit now to the bigger picture strategic insights, the outlook. How are they seeing the current economy?
They acknowledged the volatility, but felt the economy is actually doing better than maybe feared. Q1 contracted because of imports, but they expect Q2 GDP to be positive.
But watching spending?
Yeah, slowing domestic spending is definitely a risk they're keeping an eye on. Tariffs are hitting import-heavy categories, sure, but they also noted consumers seem to be cutting back a bit on services, like travel and recreation, which might help ease some price pressure. Overall, they feel well-positioned with their liquidity and capital for whatever comes.
Okay, and based on Q2 performance, how's their full-year guidance looking now? Any updates?
Generally positive updates. They're now confident of hitting the high end of their non-interest income range, which was $2.5 to $2.6 billion.
Good.
Total non-interest expenses are tracking towards the lower end of their $5.4 to $5.5 billion range.
Even better.
And net charge-offs for the full year. They now expect them to be less than 40 basis points, which is an improvement from their initial outlook. Year-to-date, they're at 33 basis points.
Excellent.
And they expect criticized loans to keep declining, maybe just at a more moderate pace than the big drop we saw this quarter.
So generally upgrading the outlook across the board sounds positive. What about their core strategic priorities? Did they reiterate those?
They did, kept it consistent. 4 key priorities. 1, grow in New England and Long Island. 2, optimize resources through simplification, basically, efficiency. 3, enhance system resilience and scalability. And 4, continue scaling up their risk management capabilities.
A clear, focused strategy.
Seems that way.
Now, there was some interesting discussion on the call about their business model and M&A philosophy. Do they sound like they feel pressure to get bigger, compete with the mega banks on scale?
Not at all, actually. This was quite interesting. Management pretty directly dismissed that idea.
Oh, right.
Yeah, they emphasized their model is centered on serving their specific communities, bringing the full bank to their customers in those areas. They argued they can maintain high efficiency without massive scale, avoiding some of the complexity that comes with it.
So depth over breadth. Quality in their chosen markets matters more than just sheer size.
That was definitely the message. They don't feel they need to be the biggest to be successful or serve their customers well.
So if they're not chasing M&A just for scale, what would make them consider a deal?
They said they're open to M&A, but it has to be the right partner and the right opportunity. They specifically mentioned focusing on deals that are in market or in immediately adjacent markets.
Geographic sense.
Right. And importantly, not just for scale's sake, they also addressed a potential concern, saying if an acquisition target had, say, high commercial real estate concentrations, they have ways to manage that risk through loan sales or risk transfer trades.
So a very disciplined, risk-aware approach, even when thinking about M&A.
Seems so. Focused on fit and managing potential downsides, not just growth at all costs.
And finally, any talk about future stuff, like stablecoins, digital currencies. Are they playing in that sandbox?
They touched on it briefly, basically indicated they're monitoring those developments. They said they'd be prepared to partner up and service customers if things like stablecoins become a preferred way to pay, especially for, say, off-hours transactions.
But only if.
Only if it offers genuine ease of use and cost efficiency. So a practical wait-and-see stance, not jumping in head first, but ready if the market really moves that way.
Okay, pragmatic. So wrapping this all up for our listeners, what's the key takeaway? M&T Bank's Q2, it really paints a picture, doesn't it?
Yeah.
A bank navigating complexity with a very clear plan.
Absolutely. Strong execution, especially around managing risk and returning capital to shareholders. Their whole investment thesis seems quite optimistic, focusing on this resilient, purpose-driven model.
Yeah, that track record of outperforming through credit cycles, the consistent dividend growth, the disciplined capital stewardship, it really stands out.
It does. And even with all the macro uncertainty out there, their focus on de-risking, growing in specific niches, and running efficiently seems to position them pretty strongly.
It feels like a bank really playing to its strengths, prioritizing that value creation over just getting bigger for the sake of it.
Well said.
Okay, let's switch gears then. Time for our This is not financial advice segment.
All right, let's brainstorm like we're pitching to an investment committee. An outrageous but plausible idea.
Exactly. So thinking about M&T Bank, we've talked about the consistent de-risking, those strong stress test results, the clear capital return strategy, buybacks, likely dividend hike coming.
Right.
So here's an idea. What about a capital efficiency pair trade?
Okay, intriguing. How would that work?
The play would be go long that bank, buy their stock,
Okay, the long side.
and then consider short position against it, specifically shorting a regional bank peer, maybe one that has a much higher CET1 ratio than average, but isn't being very clear about returning that excess capital.
Or maybe one that's talking a lot about needing big, potentially dilutive M&A just to get deposit scale, adding integration risk.
Exactly, one of those scenarios.
Okay, so long dep, short a less capital efficient or potentially riskier acquiring peer. What's the core rationale driving that?
The thinking is this. M&T's management is being really proactive. They're de-risking, bringing down that required capital buffer, the SCB. Their long-term CET1 target is 10%, even though they're running higher now for prudence.
And they're actively returning the capital they don't need for that target.
Right. Aggressive buybacks, signaling the dividend increase, plus that disciplined M&A approach we talked about, focusing on fit, managing risk. It reduces integration headaches and credit surprises compared to just buying scale.
So the bet is that M&T is just more effectively returning capital and managing risk on a per-share basis.
Precisely, which could lead to better risk-adjusted returns compared to peers who are maybe hoarding capital without a clear plan or chasing scale through potentially messier, riskier deals. It's a bet on Milana's strategic prudence and their efficient use of capital.
A bet on smart capital deployment. I like it. Plausible, potentially outrageous. Fits the bill.
Okay, but remember everyone, this deep dive, and especially that trade idea, it's purely for informational purposes.
Definitely not financial advice. Do your own homework.
Absolutely. We really encourage you to think about how these insights from M&T's quarter align with your own investment thesis. What stood out most to you? Was it the capital return, the de-risking focus?
Yeah, we'd love to hear your thoughts. Your feedback always helps us as we keep digging into these earnings calls.